If you really want to get a handle on what's driving changes in your paycheck, the prices you see at the store, and honestly, the fundamental strength, the resilience, really, of the entire U.S. economy, there is one economic number. It comes out quarterly from the Bureau of Labor Statistics that cuts right to the core of it all. It might sound a little dry at first glance, U.S. productivity data, but this isn't just some dusty statistic for economists, locked away somewhere.
Not at all.
This is a vital sign. It's like a snapshot of how efficiently the country is turning effort into output. And that efficiency, or, well, lack of it, sends ripples through every corner of the economic landscape. It directly impacts wages, costs, our collective prosperity.
That's exactly right. Think of it as checking the horsepower and the fuel efficiency of the nation's economic engine. Is it humming along? Is it getting more output for every hour worked, every bit of capital invested?
Or is it sputtering, maybe wasting resources?
Exactly. Right? Or just, sputtering along. And the sources we've been digging into provide a fantastic bedrock for understanding this. We have some foundational economic text here that walks us through the essential concepts, what productivity truly means, how it connects to business costs, the intricate dynamics of the labor market,
right,
and how all of these sort of micro and macro elements fit together.
So our mission today in this deep dive is to take these core foundational concepts, pull them right out of the material you shared, and connect them directly to that real-world quarterly U.S. productivity data.
Yep.
We want to unpack what those numbers actually represent, strip away any sort of abstract feeling, and deliver the core insights that explain why this data point is so fundamentally important. For you listening, for businesses, for the country's economic path forward. Okay, let's roll up our sleeves and really unpack this.
Let's do it. Let's start with the absolute basics straight from the source.
Right.
What exactly are we talking about when we use the term productivity in this economic context?
Yeah, good question.
The material defines it primarily through the lens of productive efficiency. And the go-to measure, especially for labor productivity, is output per hour worked.
Output per hour.
Sometimes you'll see it referenced as output per worker, but the per hour metric is often preferred, because it accounts for variations in work schedules, part-time versus full-time, that kind of thing.
Okay, output per hour worked. Seems straightforward enough. How much stuff, or maybe how many services, does the average person produce in, 60 minutes?
Right.
But the sources immediately introduce a critical distinction, and this seems key to understanding business success. Productive efficiency versus allocative efficiency.
Ah, yes. Crucial.
You need both, apparently, but they are different things.
Absolutely crucial distinction. Productive efficiency, like we just said, is about maximizing output from a given set of inputs. It's about operating on your production possibility frontier, basically.
Yeah.
Using your resources without waste to produce as much as physically or technically possible.
Okay, making the most stuff possible.
Right. Allocative efficiency, on the other hand, is about producing the right mix of goods and services, the ones that consumers actually want and value the most.
Yeah.
It means your production aligns with what people are actually demanding.
Got it. And the sources have a great, simple example to drive this home. A factory, right? It's perfectly managed, machines running smoothly, workers optimally utilized, churning out 2,000 units a day, maximum capacity, productively efficient, right? Sounds great.
Totally productively efficient. They've mastered the mechanics of production. They're hitting their numbers.
But then the example asks, what if those 2,000 units are something nobody wants to buy?
Oh.
Market demand is zero. Maybe it's a product that's become obsolete, or maybe they just completely misjudged consumer tastes.
Yeah, it happens all the time.
So in a business sense, despite being this model of productive efficiency, that factory is a complete failure.
Total failure. They're not allocatively efficient because they're producing something of literally no value to the market. All that effort, all that efficiency, wasted.
And the sources cleverly flip that around too. They show you can be allocatively efficient, at least in theory, but fail productively.
Right.
A company might do brilliant market research, pinpoint exactly what product customers are desperate for, nail the pricing, have a perfect marketing plan totally aligned with consumer demand. They know what people want.
Yeah, their planning, their market alignment, it just screams allocative efficiency. They've done their homework.
But then
maybe their factory equipment is ancient and constantly breaks doir Or their supply chain logistics are a nightmare, causing raw material delays. Or maybe internal processes are just incredibly clunky and inefficient.
So they know what people want, and people do want it.
Yes.
But They simply cannot produce it. Not reliably, not quickly, not cost-effectively.
Right. They just can't execute.
So they're like the perfectly scouted sports team with a brilliant game plan that, I don't know, fumbles the ball or gets penalties every single time.
Exactly like that. Perfect analogy. The source material is crystal clear. True business efficiency, the kind that leads to profit, sustainability, requires both. Productive efficiency, making things well, and allocative efficiency, making the right things.
Making the right things well.
Precisely. And the measurement itself, as the sources note, it varies in difficulty.
Right, I was thinking about that.
Counting physical units on a manufacturing line, widgets, cars, computer chips, that lends itself relatively well to calculating output per hour. You have tangible units you can count.
Easy enough. But what about the service sector? That's a huge and growing part of the U.S. economy. How do you measure the output of, say, a teacher? Is it student test scores, hours spent lecturing? What about the output of a consultant or a software developer? It's incredibly challenging to quantify in neat hourly units.
It really is. It adds a layer of complexity, for sure. And this means that the aggregate productivity data, while it's invaluable, is drawing from sectors with very different measurement challenges. That's something important to keep in mind when you see that overall number.
Good point. So it's an average across very different types of work.
Definitely. And this brings us squarely to the actual data we started with. As the source material highlights, the Bureau of Labor Statistics, the BLS, is the primary source for U.S. productivity data, and they publish it quarterly.
Quarterly, so it's not just an annual look back.
No, it's a relatively frequent checkup on the economic engine. It gives us a more current pulse.
And the sources include Figure 1, which gives us a bit of a historical view. It shows the annual % change in output per hour worked specifically for the business sector from 1992 through 2008.
Yeah, it's a good visual.
Looking at that graph, you see it's definitely not a smooth ride, is it? There are periods of pretty strong productivity growth, like the late 1990s.
Oh, yeah. That often coincided with the tech boom, right? Increased investment in IT.
Seems likely.
Yes, you see those peaks there, showing annual growth rates comfortably over 2%, sometimes pushing towards 3% or even 4%. That was a period where many argued that new technologies were fundamentally changing how businesses operated, making labor and capital just more productive.
And the shaded areas on that graph, those represent recessions, economic downturns. What does that historical data show about how productivity behaves during those rough patches?
It's quite interesting, actually, and not always what you might intuitively expect. Look at the recession around 2001. Productivity growth actually holds up relatively well initially. It even increases slightly for a period in there.
Really? How does that work?
Well, it can happen for a few reasons during downturn. Businesses often cut costs drastically, right? That can involve laying off less productive workers first. So the average output per remaining worker actually rises.
Ah, okay. Sort of a statistical effect.
Partly. Plus, surviving firms might double down on making their core processes more efficient just to stay afloat. So you could see a temporary boost in the measured productivity of the workforce that's left.
Almost a painful form of efficiency gain, driven by sheer necessity.
Exactly. However, if a recession is deep and prolonged, like the one that started in late 2007, you can see that at the very end of that Figure 1 graph, you might start to see productivity growth slow down or even turn negative.
Why the difference?
Because businesses pull back hard on investment. Investment in new technology, new equipment, training, the very things that fuel long-term productivity gains. Innovation can slow down, R&D budgets get slashed, and that eventually shows up in the numbers.
So Figure 1 gives us a kind of visual history lesson. It shows how productivity ebbs and flows with the overall economic cycle, reacting to both boom times and bust conditions in sometimes complex ways.
Precisely. It's not a simple straight-line relationship with economic growth at all.
Fascinating. Okay, let's pivot then from the measurement side to the impact. The sources really emphasize that improving input productivity, getting more out of your labor, your machines, your land, your raw materials, is a fundamental strategy for controlling costs, especially as a longer-term solution.
Oh, absolutely key. Key for any business's sustainability. You can maybe cut costs in the short run by, squeezing suppliers or slashing the marketing budget.
Yeah, temporary fixes.
But for enduring cost competitiveness, you have to become more efficient in your core production or your service delivery process. It's fundamental. If you can produce more units or deliver more services with the same number of employee hours or the same amount of raw material or the same capital equipment, your cost per unit of output naturally decreases.
Right, because your total costs aren't rising as fast as your total output is. The sources bring in the concept of average total cost, or ATC, to explain this. They show that familiar U-shaped curve in figures 3 and 5. Can you walk us through why ATC typically takes on that U shape? What's driving that?
Certainly. So think about it. At very low levels of output, average total cost is usually quite high.
Okay.
A big reason for this is that you have high fixed costs. Things like rent for your factory or office space, maybe loan payments for big equipment, salaries for your core management staff.
So stuff you have to pay no matter what.
Exactly. Costs that don't change regardless of whether you produce 1 unit or 1,000 units. So when you're only producing a few units, you're spreading those large fixed costs over a very small output. That makes the average fixed cost per unit really high, and thus the average total cost per unit is high.
Okay, makes sense.
But as you increase output, that fixed cost gets spread thinner and thinner across more and more units. So average fixed cost goes down, pulling the average total cost down with it, at least initially. There can also be initial gains from specialization as workers focus on specific tasks and get better at them.
So at first, increasing production actually makes each unit cheaper on average. That's the downward slope of the U. But eventually, that U shape turns upwards. That's where diminishing returns kick in, right?
Precisely. This is where the classic law of diminishing marginal returns become really apparent. As you keep adding more of a variable input, like, say, labor, to a fixed input, like the size of your factory or the number of machines you have.
Right, you can't just keep cramming people in.
Exactly. The additional output you get from each additional worker that's the marginal product of labor will eventually start to decrease. Think of adding more and more baristas behind a single espresso machine. They'll eventually start getting in each other's way, or there just isn't enough counter space for them to work efficiently.
Their individual productivity starts to fall off. They're less efficient per person.
Exactly. And when marginal productivity falls, marginal cost rises. They're inversely related, like two sides of a coin. The cost of adding one more unit of output goes up because you need relatively more labor input or more time to get that extra unit made.
Okay.
And this rising marginal cost eventually starts to outweigh the effect of the still falling average fixed cost, and it starts pulling the overall average total cost per unit upwards again. That's what creates the bottom and the upward slope of the U.
The source's example in Figure 4, illustrating factory size, seems perfect for visualizing this. You might have a small factory that's incredibly efficient and low cost when it's producing, say, 3,000 units. Maybe its average total cost is just $8 per unit there. That's its sweet spot, right? It's optimal productive capacity at that scale.
Absolutely. It's designed for that level of output.
But what happens if demand for your product suddenly explodes and you try to push that same small factory to produce maybe 500 units?
Yeah, you're operating way beyond the scale it was designed for. You have to squeeze in extra shifts, maybe use less efficient overtime labor. Machines are running nonstop with less maintenance time.
Workflow bottlenecks must become severe.
Oh, totally. Your workers, constrained by the fixed space and the fixed amount of equipment, become significantly less productive per hour. They're tripping over each other, waiting for machines. Things break down more often.
And that lack of productivity just slams your costs, right? The source illustrates that trying to force 5,500 units out of that factory designed for 3,000 could send your average total costs skyrocketing, maybe up to $10 or even higher per unit.
Exactly, because you're operating incredibly inefficiently relative to your capital structure, relative to that factory size. You've gone way past the point where you're getting the best return on your investment in that particular size factory. You're productively inefficient at that higher output level within that fixed structure.
That inability to scale efficiently or just hitting those productive capacity limits relative to demand, that's got to be a classic business challenge.
It absolutely is. It trips up a lot of growing companies.
And the sources provide a pretty dramatic real-world case study that seems to embody this kind of cost and scaling failure. Webvan.
Ah, yes, Webvan. A famous or maybe infamous example from the late 90s, early 2000s .com bubble.
Right, online grocery delivery. Big ambitions.
Huge ambitions. They had this grand vision, investing just massive amounts of money in these enormous, highly automated warehouses. Think very, very high fixed cost and a really complex logistics network to go with it.
Sounds expensive.
Extremely. And the source notes their rapid demise was due to essentially disappearing cash reserves and a significant drop in order volume before they finally shut down.
Yeah, their CEO explicitly mentioned shutting down rather than continuing to operate with high losses and decreasing cash. That says a lot.
It really does.
Hmm.
It strongly suggests they never achieved the necessary productive efficiency at scale to make the business model actually work. Their cost structure, particularly those huge fixed costs tied up in the infrastructure.
The giant warehouses.
Exactly. The warehouses, the custom vans, the automation. It demanded a massive volume of orders just to spread those costs thinly enough to even approach profitability. To get down the steep left side of that theoretical ATC curve.
And when order volume fell short or dropped?
Their average cost per order would have just skyrocketed because now they're spreading those massive fixed costs over fewer and fewer deliveries. And on top of that, their variable costs per delivery might also have been high due to inefficiencies in the picking, packing, and delivery routes that weren't optimized for those lower, perhaps more spread out volumes.
So they just couldn't get their whole production and delivery process efficient enough to generate cash rather than just burn through it, especially since demand wasn't consistently at the sky-high level their expensive infrastructure really required.
Pretty much sums it up. It's a stark reminder, isn't it? Even a business with a potentially good idea, you could argue online groceries had allocative efficiency. People wanted it over. Eventually can fail spectacularly if it cannot achieve productive efficiency, particularly in managing its cost structure as its scale changes or fails to meet projections.
Absolutely. It illustrates just how critical productive efficiency is, not just for shaving off a few pennies, but sometimes for the very survival of a whole business model. Okay, so productivity has a direct line, clearly, to business costs. How about something even more personal? Wages. How does that productivity number relate to the money that ends up in people's pockets?
Right, the paycheck connection. This is explained beautifully in the sources through the mechanics of the labor market. The fundamental link here is the marginal product of labor, or MPL.
Marginal product of labor.
Simply put, it's the extra output a firm gets by hiring one additional worker, just one more person. How much more stuff do they produce?
Okay.
And the demand for labor by a firm is fundamentally derived from this marginal product. The source states that the downward sloping portion of a firm's marginal revenue product curve for a factor like labor, well, that is its demand curve for that factor.
Whoa, okay, marginal revenue product. Break that down.
Good point. Marginal revenue product is simply the marginal product of labor, the extra output multiplied by the price the output sells for. So it's essentially the dollar value added by that extra worker.
Got it. So if hiring an extra worker adds a lot of valuable output that sells for a good price,
then the firm is more willing and able to pay a higher wage to attract that worker, or workers like them.
and if they add very little valuable output,
Then their potential wage is lower because the firm just doesn't get as much financial benefit from hiring them. The more productive a worker is, in terms of the value they generate for the firm, the higher the potential wage they can command. It ties directly back to productivity at the micro level.
okay, that makes sense.
And this demand for labor isn't just about the worker's inherent skill either. It's also, crucially, about what they're helping to produce. This is the concept of derived demand the sources highlight.
Right. The demand for inputs like labor is derived from the demand for the final good or service they produce. It's not demanded for its own sake.
Perfect summary. The source gives the example of construction workers. The demand for construction workers isn't because people simply have some abstract desire for construction workers hanging around.
No, we want buildings.
Exactly. It's because people want new houses or offices or bridges, and construction workers are necessary to build those things. So if the demand for new houses booms.
The derived demand for construction workers goes up.
Exactly. And builders are willing to pay more to get them. But if the housing market crashes.
The derived demand for those workers collapses.
Right. Irrespective of how skilled those individual workers might be. Their individual productivity might be the same, but the value of what they produce has plummeted in the market size.
So my wage potential as, say, a skilled carpenter isn't just about how fast I can frame a wall. It's also heavily influenced by how many people are lining up to buy the house I'm working on.
Precisely. That makes intuitive sense, doesn't it?
It does. The sources also mention other factors that can shift this labor demand curve besides just the demand for the final product.
Yes. Changes in the use of complementary factors are a big one. Things that work with labor.
Like tools.
Exactly. The source suggests that if, say, accountants are given better computer software, maybe sophisticated databases, or more comprehensive digital reference libraries, tools that make them more effective and increase their output per hour.
They can do more audits or more complex analysis in the same amount of time.
Right. Their marginal product of labor increases. They become more valuable to the firm. And this increases the firm's demand for accountants at any given wage rate. The whole labor demand curve for accountants shifts to the right.
And presumably, technology that replaces labor would do the opposite, shift the demand curve left for those specific workers.
Correct. If automation takes over tasks previously done by humans, the demand for humans to do those specific tasks falls.
Okay. And ultimately, just like in any market, wages are the price, right? Determined by where the supply of labor people looking for jobs intersects with the demand for labor firms looking to hire.
Yep. Figure 12.11 in the source lays this out very clearly. Panel A shows an increase in labor demand. Maybe that's due to increased productivity, higher MPL, or maybe increased demand for the final product, that higher drive demand.
Okay.
This shifts the demand curve to the right. And the result?
Yeah.
A higher equilibrium wage and higher employment. More people working at better pay.
The ideal scenario.
Pretty much. Panel C shows the opposite. Imagine an increase in labor supply. Maybe more people enter the workforce, swing jobs, or immigration increases. That shifts the supply curve to the right.
More workers available.
Right. And the result there is typically a lower equilibrium wage, but more people actually employed overall. Basic supply and demand.
So the simple theoretical link seems clear. If overall productivity, the MPL, goes up, then labor demand should go up, and that ought to push wages higher, assuming, the supply of labor doesn't change too dramatically at the same time.
That's the basic textbook connection.
But I sense a but coming. The sources then introduce a significant layer of complexity, especially in that section on technology and the wage gap. This gets into the idea of skill-biased technological change.
Yes, this is a huge topic in labor economics, and the sources delve into it quite nicely. The core idea is that technological progress isn't neutral in how it affects different types of labor. It doesn't lift all boats equally.
Okay.
Some technologies might be substitutes for, say, low-skilled or routine tasks. Think about automating basic data entry or simple assembly line work that directly replaces some workers.
Right.
But other technologies, and often the most advanced ones, are actually complements to high-skilled labor. They are tools that make highly skilled workers even more effective and productive than they were before.
Like that better software for the accountant we mentioned, or sophisticated analysis tools for a data scientist makes them wizards.
Exactly. Those are perfect examples. And the source presents this really intriguing idea that increases in the supply of skilled workers, like more people getting college degrees, can actually induce the development of these complementing technologies.
Wait, how does that work? The supply of workers encourages certain tech.
The argument is if there's a larger pool of highly educated scientists, engineers, analysts, programmers available in the workforce, or there's a greater incentive for companies and innovators to develop software, machinery, and processes that specifically leverage and enhance their unique capabilities. Why build tech for skills that are scarce when you can build it for skills that are becoming more abundant?
So the availability of skilled people encourages the creation of tools that make those skilled people even more productive and valuable. It sounds like a kind of feedback loop, a virtuous cycle maybe for the skilled.
That's the argument presented. And because these technologies significantly increase the marginal product, and thus the marginal revenue product of skilled labor, they massively increase the demand for skilled workers. Now, if the supply of skilled workers hasn't increased as fast as this technology-induced demand has, or even if it has increased, but the demand effect is just stronger, well, the wages for skilled labor get bid up a lot.
And that contributes to a widening gap between the wages of high-skilled workers and lower-skilled workers, whose jobs might even be threatened by different kinds of automation.
Precisely. The sources note the argument that the rapid expansion of college education over past decades has actually contributed to this phenomenon. A larger supply of college-educated workers potentially spurred the development of more skill-biased technologies, which in turn reinforced the economic value of getting that college degree, the so-called college premium.
Wow, that's a powerful feedback loop. More supply of skill leads to tech that favors that skill, which increases demand for that skill, which pushes up wages for those with the skill, widening the gap. That's complex.
It is.
The sources also briefly mention other factors often cited as drivers of wage inequality, like the decline of labor unions and increased international trade. What do they say about those?
They do mention them, and they cite some evidence suggesting that while those factors are certainly relevant, studies indicate their direct contribution to the overall widening of the wage gap across many different sectors.
Even sectors not directly exposed to trade.
Right, like healthcare or domestic services.
Yeah.
Their impact might be less significant than the role of this skill-biased technological change. The source points out, for instance, that the rise in wage inequality in places like the US and UK seemed to precede the really significant decline in union membership.
Interesting timing.
Yeah. And while trade definitely impacts wages in specific industries that are directly exposed to global competition, the argument presented in the source is that skill-biased technological change seems to be a more pervasive, economy-wide force affecting the wage structure more broadly.
But the sources also hint these factors might not act totally in isolation. They could interact with technological change.
Precisely. That's a key nuance. The material suggests these factors can reinforce each other. For example, if skill-biased technology increases the potential earnings for skilled workers significantly, it might make the wage compression effects often sought by unions trying to narrow the gap between high and low earners within a company less appealing to their more skilled members. This could potentially weaken union support or bargaining power over time.
Okay.
And similarly, trade expansion, especially with countries that have very different wage structures, might incentivize firms here to adopt more skill-biased technologies faster to remain competitive by boosting high-end productivity, which further accelerates the demand for high-skilled labor relative to low-skilled labor.
So technology isn't the only factor in wage gaps, but the sources seem to present it as a primary driver, possibly interacting with and maybe amplifying the effects of trade and union trends.
That seems to be the perspective offered in this material, yes.
So, okay, pulling that thread together. While increased productivity can lead to higher wages overall by boosting labor demand, the nature of that productivity growth, particularly if it's heavily skill-biased due to technology, is really crucial in determining which workers see those wage gains. And it could actively contribute to wage inequality.
That's a major takeaway.
Before we zoom out completely to the macro economy, the sources had that one intriguing section title, Permanent Scars, the Effects of Wages on Productivity.
Ah, yes. That title is quite evocative, isn't it? Sticks with you.
It does. While the specific mechanisms aren't really detailed in the text we have, the title itself strongly implies a feedback loop. It suggests that the level or structure of wages isn't just an outcome of productivity and labor market dynamics,
but can also have lasting effects on productivity itself.
So it's not just productivity leads to wages, but potentially also wages lead back to productivity, creating long-term impacts that could be felt as scars. Is that the idea?
That's certainly the implication you get from that title within the source material. It suggests a more complex, maybe even a two-way street, compared to the primary focus we've had on demand-driven wage determination.
How might that work? Any hints?
Well, the specifics aren't laid out here, but you could speculate. Perhaps very low wages lead to poor worker morale, maybe lower effort, higher turnover, less incentive for firms to invest in training their low-wage workforce.
Which would hinder future productivity growth.
Exactly. Or maybe workers stuck in low-wage jobs can't afford further education or training for themselves, trapping them and limiting the economy's overall skill development. Conversely, maybe very high wages in certain sectors incentivize rapid automation that boosts capital productivity, but displaces a lot of labor, creating social disruption that has its own long-term economic costs. The specifics aren't in this text, but the idea that wages themselves have a persistent shaping influence on future productivity is definitely raised by that title.
Okay, that adds yet another layer to consider. So we've connected productivity to micro-level business costs and then to the labor market dynamics influencing wages, highlighting all these complexities introduced by technology and skills, and even this potential feedback from wages to productivity. Let's now pull back and look at the biggest picture. How does this micro-level efficiency and productivity ultimately impact the health and the growth potential of the entire national economy? The macro view.
Right, the big picture. The sources use a really powerful analogy here. They compare economies to living organisms, having states of health, vital signs, and life cycles.
Okay, I like that.
And in this analogy, productive efficiency is absolutely a core vital sign for the economic body.
Yeah.
It's like checking the heart rate and blood pressure.
And inefficiency or waste is like a debilitating illness, like high cholesterol clogging the arteries.
Precisely. The source explicitly states that waste within an economy has a depressing effect on the potential growth rate. An economy that is just riddled with inefficiencies, misallocated resources, unproductive processes, labor, and capital not being used effectively.
Oh, it's just sluggish.
It's inherently limited in how fast it can expand its total output. You're leaving potential growth on the table simply because you're not making the most of what you actually have.
It goes right back to that fundamental economic problem mentioned early in the source scarcity. We only have limited resources, and productivity is basically the measure of how well we use them.
Exactly right. An economy that is efficient at utilizing its scarce resources is not only able to grow faster in the good times, but it's also far more resilient. It's better equipped to handle external shocks like, say, an energy crisis, or internal changes like shifts in consumer demand.
Like having a well-oiled machine versus a clunky, unreliable one that breaks down under stress.
Perfect comparison. The reliable machine handles unexpected stress much better. And the sources use a pretty dramatic historical example here: the economic collapse of the Soviet Union. They attribute it significantly to the crushing effect of waste.
Because their centrally planned system, it lacked the natural feedback mechanisms, the signals, to identify and eliminate all those pockets of inefficiency that must have built up.
That's the core argument presented. Without market prices and competition providing clear signals about where resources were being wasted or misallocated, inefficiency became systemic. It just permeated everything. And ultimately, it became unsustainable. It ground the entire economy down.
Wow.
And this highlights a key point the sources make about the role of free markets in this context.
Right. How do free markets fit into this macro picture of efficiency and growth, according to the sources?
Through their inherent mechanisms of communication and competition. Market prices, first off, act as incredibly efficient communication signals. They tell businesses and individuals where resources are most valued, where shortages exist, where surpluses are piling up, and implicitly where things are being used inefficiently.
So prices guide resources.
Yes, and then competition acts as powerful pressure. It forces firms to pay attention to those signals. If a firm's unproductive, its costs will be higher, making its prices less competitive. Competition then pushes them to either become more productively efficient and maybe more allocatively efficient too, or, well, eventually be driven out of the market by more efficient rivals.
It's like a constant decentralized cleanup process for the economy, identifying and clearing waste almost automatically.
That's a great way to put it. It helps prevent waste from accumulating to those dangerous systemic levels, like arguably happened in the Soviet case. And this, the sources argue, makes a market-based economy more sustainable in the long run and enhances its potential for growth.
Okay. And the sources also connect these efficient periods of growth and low unemployment to something else important: the funding of social safety net programs. Things like Social Security, Medicare, unemployment insurance. How does that link work?
It's fairly direct. A productive, efficiently growing economy generates more wealth. Businesses are more profitable, workers are employed at better wages, wages that are hopefully underpinned by that productivity growth.
Which means a stronger tax base.
Precisely. When businesses and individuals are thriving, the tax revenue collected by the government is stronger. This allows those vital social safety net programs to be funded and maintained properly.
So they can provide that crucial layer of stability and support during the inevitable economic downturns or for people facing hardship.
Exactly. Whereas a stagnant economy, one bogged down by inefficiency and slow growth, simply cannot generate the wealth required to adequately support those programs. That makes society much more vulnerable when times inevitably get tough.
So it really cascades up. Micro-level productive efficiency, hopefully fostered by competitive markets, scales up to create a more robust, faster-growing, and ultimately more resilient national economy, one that's capable of supporting both a higher standard of living and those important social safety nets.
That's the connection the sources draw.
And the ultimate measure of all that national output, the total economic activity, the sources define that as GDP, gross domestic product. Productivity, then, seems like it must be a fundamental long-term driver of GDP growth itself.
Absolutely. Over the long haul, increases in total output, or GDP, per person are fundamentally driven by increases in output per hour worked. It comes back to productivity. If you want the overall economic pie to grow consistently year after year, decade after decade, you need to get more efficient at making it. There's almost no other way in the long run.
Okay, wow. This deep dive has covered a ton of ground. We went from basic definitions to business costs to wages and skills gaps, and now right up to the health of the entire economy. Let's try to bring it all back together, back to where we started. That quarterly U.S. productivity data released by the BLS. After exploring all these connections, why is that specific number such a crucial indicator to watch?
Because it's one of the most comprehensive yet timely signals we get on the underlying health and, crucially, the efficiency of the U.S. economy at a really fundamental level. When that number comes out each quarter, it's telling us something important about the collective productive capacity of the nation's businesses and its workforce over the previous 3 months. It's a core vital sign.
And changes in that number, up or down, are signals about what might be happening beneath the surface of other economic news.
Exactly. A significant jump in productivity, for instance, can signal that businesses are successfully implementing new efficiencies, maybe adopting new technologies effectively. This could mean that longer-term cost pressures might ease up a bit.
Good for inflation, potentially.
Potentially, yes. It also signals that the value generated by labor, that marginal revenue product, might be increasing, which, in theory at least, puts upward pressure on labor demand and potential wages. Though, as we discussed, the link to individual wages is definitely complex and depends on how that productivity is achieved.
Right, the skill bias factor.
And crucially, strong productivity growth signals that the economy's speed limit, the rate at which it can grow without sparking serious inflation, has potentially increased. The economy can produce more without hitting resource constraints quite as quickly.
Okay. Conversely, then, a weak or maybe even falling productivity number is a yellow flag, or maybe even a red one.
It certainly warrants attention. It suggests that unit labor costs might be under upward pressure over time, hindering businesses' ability to control prices without sacrificing their profit margins. That can feed into inflation or squeeze investment. It signals that the fundamental engine of value creation per hour is slowing down, which limits the potential for broad-based wage increases that are driven purely by higher labor value. It makes wage gains harder to come by without just passing costs along.
And for the economy as a whole.
It indicates that the economy's potential growth rate is constrained. It makes it harder to expand output, create jobs sustainably, and, as we just discussed, generate the resources needed to fund public programs and social safety nets in the long run.
It really underscores that productive efficiency isn't just some abstract academic concept for textbooks or, something only CEOs should obsess over in boardrooms.
Not at all.
It's a fundamental engine driving the potential for prosperity. It directly impacts businesses' bottom lines. It influences the demand for labor and the potential for wages, and it determines an economy's ability to grow robustly and withstand the inevitable challenges the future holds. That quarterly data release really is a vital, must-watch snapshot of these core dynamics in action.
It's the closest thing we have, maybe, to a regular report card on the economy's underlying ability to perform at its best, to use its resources well.
Yeah. This journey through the source material has made the interconnectedness just abundantly clear. Productivity isn't just output per hour. It's intricately linked to business costs. It's a key factor influencing labor demand and potential wages, filtered through all those complex forces like technology and skills. And it's absolutely fundamental to an economy's capacity for sustainable growth and its resilience against shocks. Watching that quarterly BLS number really is watching a key indicator of the economic engine's performance.
It provides such essential context for understanding so many other economic data points that come out, from inflation to employment to GDP itself.
Okay, so thinking about everything we've discussed, the definition of productivity, its link to costs, that complex relationship with wages shaped by technology and skills, its role in overall economic health, and considering this continuous push for efficiency, often driven by innovation. Here's something to leave you, our listener, with. If technology is indeed increasingly skill-biased, potentially making highly skilled workers ever more productive while automating more routine tasks, what does this relentless pursuit of output per hour ultimately mean for the future landscape of work itself?
That's the big question.
How might ongoing technological advancements continue to reshape not just the overall size of the economic pie, but the very types of jobs that are available in the future? And maybe more importantly, how the potential for wage growth might be distributed across different skill levels in the decades to come. What happens if productivity gains year after year consistently benefit only a shrinking portion of the workforce?
It raises really profound questions, doesn't it? Questions about education, about retraining, about how society adapts to ensure that the undeniable benefits of increased productivity, of that growing pie, are actually broadly shared, not just concentrated.
Absolutely. Definitely something to keep in mind next time you see that quarterly productivity report hit the news.